And speaking with that, so for this week, one of the things, we don't have a series per se, but we've been talking a lot about the fund and the expansion. I'm going to keep elaborating on that. But before we do, I wanted to share with you a quick little story I thought was interesting. And it's perfect timing since Toshi's going back to this beautiful place called Vegas that everybody seems to love. And everybody knows Wynn and Encore. Anybody who's ever stayed there knows that is a very, very classy place. They've got some pretty incredible work that they've invested in there and done. But the story isn't necessarily about the actual resort itself. It's actually about the family, the Wynn family. Several years back, they actually, as you guys know, they're very well known, very successful. Would you guys agree? They have a huge brand that they built. They're worth a lot of money, and they've been very successful. One of the things, though, is just like any type of famous family, whenever you get to a place where you want to go on vacation, the last thing you want is to get somewhere and everybody knows that you're there. And it's this whole ordeal just to go on vacation because everybody's trying to take pictures with you and it becomes a mess. And so they were going to go to Paris and take a nice little vacation, and they wanted to go kind of low key. And so they ended up staying in Paris at the Four Seasons, and they managed to get there quietly with nobody really knowing who was there. And so anyway, just to kind of stay low key, they ordered in, breakfast to their room just so they would avoid going into the groups and everybody seeing them and everything else. And so long story short, the daughter ate half of her croissant and she said, "Dad, I'm not really that hungry, but I really am enjoying this. It's really good. So I'd like to, when we come back real quick, I'm going to save this here." So she put a little note, put it there, and they left. Well, when they came back, half of her croissant was gone. And she's kind of frustrated. Like, I put a little note, must have been the cleaning person that ultimately took it anyway. And so long story short, they noticed on the phone that there was a missed phone call. And so when they answered the call, it was actually the reception team that said, "Hey, listen, our cleaning team happened to actually go into your room and clean it." They saw the note, but they realized that most likely this was not going to be as tasty as it was from the beginning. So they talked to the kitchen department and told them to prepare a special croissant to save it in a place for you so that when you came back, you could actually enjoy an actual fresh croissant. And so long story short, as you can imagine, they were very excited. She was so blown away by this act of kindness that actually started with the cleaning lady who had no idea who was actually in the room. And so what I'd like to share with you, some of the principles that he further shared with his team, because he was so impressed by how many departments were involved in just an act of kindness and going above and beyond, that actually set the standard of excellence for their organization. So it began with this piece here. The first piece of realization that he mentioned was that all participants understood the end result, customer satisfaction, and everyone accepted their role in making the experience fantastic. And that was really, it didn't matter whether it was the Wynn family or the Malero family or whatever family was there, from the cleaning department all the way up to the rest of the team. When they saw an opportunity to go above and beyond, all of the team members worked together in unity to accomplish that mission. Little did they know that that ripple effect would have an instant impact, because guess what Wynn did? Of course, he not only touted it everywhere, but he actually mirrored that process and tried to share it with his team when he got back. And so again, it's a level of excellence because of the team. The second thing that was brought up, and I really just want us to just think about this as we talk about the rest of the information that we have, is that it shows that in order to achieve satisfaction on different levels within the organization, employees / team members should be empowered to be creative, intuitive, thorough, and generous. And those were some of the key components that were his takeaway from this little vacation that taught him that there is always the next level of excellence. But it is imperative that everybody within that team is aware of the fact that all participants understand the end result. And that's what I want to share with you guys today, is as an organization, for us to go to this next level, we all have to understand that we, each individual ones, by department and as individuals, we're going to play a crucial role in the next level of the organization. And it's imperative that we understand the end results and that we understand the customer that we're trying to serve, because those customers ultimately will elevate each and every one of us and create new opportunities for all of us. Now, of course, we have to empower you and educate you so that you can be creative, intuitive, thorough, and generous. And that's really what I'm trying to do here. So for the next week or so, I'm going to be sharing with you some of the key things that we're requiring, some of the things that we're sharing with our investors, because what's changing the game for us a little bit is the fact that as a fund, we are going from dealing with just accredited investors or individuals buying mortgages from us to dealing with the whole market, anyone across the spectrum, whether they're multimillionaires or little John Doe with $5,000. At the end of the day, the whole objective is to serve our clients and treat them like they're at the next level so that we can all together grow and have stability in the company. And so I wanted to start with that story to remind us that is that level of excellence that got even the Wynn family to get to the level they are. And I feel like we're just stepping into a stepping stone. Well, who knows? Maybe we will own and invest in projects like the Wynn buildings you saw earlier, and you guys will be a huge part of that as well. So again, it's part of now we need to start thinking how each and every one of you represent a piece of that puzzle. And if we do it with excellence and we understand the end result, there's nothing that won't stop us from reaching those goals. Everybody with me so far? So just wanted to begin with that. Now, with that said, one of the things we're going to be doing in our fund, especially as we begin to market and talk about investing and trying to bring investors in, obviously all of us are responsible for sharing with the world what we're doing when we get approved with the SEC. Because again, anyone can participate in investing. And the more capital we raise, obviously the more opportunities that everybody has to grow, right? So one of the things that we want to do though is we want to do something different than most other companies that are raising money. Usually most companies, they create the sizzle and they're trying to raise the money based on how attractive something is. And don't get me wrong, investing is attractive, it creates opportunities. But we want to make sure that especially the smaller investors that have never been involved or maybe have limited experience, we want them to understand what they're getting into. In addition to that, I want you guys to understand what we're getting into because chances are most of you guys, it's not that you're dumb, it's just you're ignorant to what investing in a fund really is, right? And so what I'd like to do today is share with you a quick presentation that we've already covered for our investors and recorded it so that basically any investor, especially those that are putting less than $20,000, they're gonna be required to go through a series of videos so that they can understand what risks are involved, what they're supposed to be doing, what they need to consider. So let's begin with what we call our Fund 3 boarding requirement, part 1. So the very first thing I want you to talk about, and I want to share with you guys, is that when we're talking about investments in specifically a fund, what we are considered and what we do is under the category of alternative investments. And so a lot of people may say, well, what is an alternative investment? What is the difference between that and a stock? Because in essence, I'm buying shares in that company, am I not? And so what I want to do is give you a clear picture of what the differences are. And the difference begin with the fact that alternative investments differ from the traditional stocks and bonds in the form of what you're going to see or what we call alternative investment vehicles. It's a different type of vehicle, and I'll talk about that in just one second. I'm going to give you some of the categories. I'm sure there's others, but I just wanted to specify that when people reference alternative investments, many times you're talking about venture capital, real estate investments, precious metals, whether it's whole or in part. And what does that mean? Well, if you think about your own alternative investments, if you bought gold, you can buy gold. That's an alternative investment for you that you can own. Now you can own the gold and store it in your house, right? And put it in some type of safe, or you can go to a company that is responsible for billions of dollars and you can buy a percentage of it. Regardless, it's still technically considered an alternative investment. In the same way, if you're buying real estate as an alternative investment, then obviously you can own the whole project, or you can invest with other investors and it's tied to real estate. That becomes what we call alternative investments, okay? Now, what's important for us to understand, and the majority of money that flows into these types of alternative investments are really gonna go into this particular category. These are what I call common investment sources. And that would be a self-directed IRA, solo 401k, and sometimes even savings. Now, the reason why this is important, and I want you to understand how this vehicle or investment source ties to the vehicle, is because most people, when they invest in stocks, unless if they're a really big investment company, they're investing with their retirement money in stocks, bonds, and mutual funds. I'm sure everybody's heard that strategy, right? You really have no control. Most people have no idea where the money is, right? They just know that their money's invested in stocks, bonds, and mutual funds, right? And to a degree, what the government did is they created an opportunity for individuals to take control of their investments instead of just blindly trusting somebody else to move their money wherever they so choose. And that's when alternative investment opportunities really became available. So what they say is, hey, you can have your own 401k or IRA with your company, or you can self-direct that vehicle and select where you want it to go. And it can go into alternative investments. And that's really what we're talking about. So most of the people that we're going to be talking to that are going to want to be a part of what we do are going to have a self-directed IRA, or they might have a solo 401k. It's a very similar program. It's just basically like a self-directed 401k. And others are just going to think, okay, great. I have money in savings. I want to put this to work. I just save 15, 20, 30, $50,000. And I know that over time I want it to grow. And so these are the individuals that ultimately are going to want to put that money in these kind of alternative investments. So does that make sense so far? I want to make it real simple in the beginning so everybody fully understands. And so in essence, as a real estate investment fund, that means that investors are going to be able to use their vehicles and benefit in real estate, but it will be in part, meaning they're going to be a part owner of those investments. And that's part of what we're trying to do. So now you can kind of visualize all these people that want to retire or ultimately start saving. Now we're giving them the platforms for them to join us in alternative investments tied to real estate. Okay. Now, why is investing in alternative investments better? So I'm going to give you an example. Number one, it's not strongly correlated to the stocks and bonds market. I think everybody has seen over the years, and there's a lot of people even right now during COVID-19 who have seen the stock market go up and drop, and it's so volatile that if you're not careful, you end up following, like literally your emotions follow the wave of the cycles because you see your wealth going up or down, and it can be very, very emotional. And so if you're managing your money in stocks, unless if you're an expert, it could be very, very painful for a lot of people, right? And you're basically living in fear. And so one of the differences is, the fact that when you're dealing with a stock, the only big benefit is that we call it a liquid investment, meaning that you can sell it even if you sell it at a loss, but you can almost instantaneously get your money out to get it. And that's really part of why it creates volatility, right? Now, when you look at that versus investing in alternative investment tied to real estate, the liquidity isn't quite there, but it's a tangible investment that over time continues to build. So there's more long-term stability with the lack of the fluctuations that you're dealing with, like almost on a daily basis, depending on what's going on in the economy. So again, it's not tied to the stock fluctuation. You can achieve true diversification. That's another piece. And I'll give you an example. Most companies that are dealing with financial planning and they put people in stocks and bonds, they're like, we're going to diversify you. I'm sure everybody's ever heard that term if you've ever worked with a financial planner. But what they really do in most cases, they're buying puts, almost an insurance policy that it won't fail. And then they're buying certain stocks that they think will grow over time. But at the end of the day, one of those is going to fail and it'll basically equal out your return. So you're really not fully diversified in something. At the end of the day, most of what they're trying to plan on is, where do I get the commission, but where do I still protect the investor? And your investments are being driven by commissions, not necessarily the best return, right? So one of the benefits of having diversification in real estate, and part of kind of what makes our investment strategy different, is there are other guys out there that are using real estate investment funds. But what they're actually doing is they're saying, I'm going to use all these $50 million to buy 300 apartment units in a Class A community. Your $50 million is just a down payment. I'm going to take out an even bigger loan for $100 million. That is a 25-year loan. And then once we refinance or sell it, then you get your money back with profit. So it's not really diversified. It's tied to one specific investment. We don't feel that that is the wisest decision as an investor. So part of what we're trying to do with our real estate fund, and why I want everybody here to understand this, is because you guys are all a part of this. So our main strategy is the fact that we're going to be diversified in a variety of ways. And I'll talk more about that in a minute. We're going to be diversified with operators, meaning we're not just going to be stuck with one or two people. We're going to be diversified in different markets, which means we're not going to be stuck to just one market that we're doing business in. The other part is we're going to be diversified in asset classes. So we're not just going to be only residential or only luxury. We're going to be diversified over a variety of asset groups, which puts us in a position to really have a solid diversified plan. And that's really what we're bringing to the table that makes us different than most investment groups. Because usually most investment groups get very niche-y. But the problem with that is then you're no longer diversified. And so our goal is to, yes, still be strong and solid, but to make sure that we have multiple strategies. So if anything changes or anything happens, we have a variety of income sources to protect our investors. Does that make sense? All right, the next part, of course, is, and I'll allude to this a little bit more. I'll talk more in detail, but I want to allude to it right now, is that you become a part owner in tangible assets. And I'll explain what that means in a minute. And then you truly have a hedge against inflation. Now, one of the things that people don't realize is, and I've had, even Luis knows about this very well, when you're dealing with markets, let's say there's a lot of money being printed in our country, would you guys agree right now? Trillions of dollars of debt being printed just out of nowhere, right? I tell people that it's not just printed out of nowhere, it's printed based on how many bullets we have. Because really, when you look at the country's credit score, it's tied to either their financial abilities or how many bonds we have. And how many of you guys would agree that we're not being approved based on our credit score, based on income, we're approved based on our power. right now. And that's really what it comes down to. So when you look at that, usually when there's a lot of money printed, there is some type long-term of overall inflation. That is how you begin to deal with the counter. There's always something that takes place. So if we borrow too much money and we print too much money, there's going to be an inflationary period over time. Now, in America, we may not see a 20, 30%, inflationary market. If we did, that would be insane. But I know in other countries that have printed exceeding amounts of money, and ultimately that did happen. But what's interesting to note is that the people who own real estate, because of those inflationary markets, they actually benefited from the inflation. Because if you think about it, rents went up based on inflation, but their debt stayed the same. So they were able to pay off their debt much faster and now own an asset that was worth more. So just think about that from that perspective. Now, also look at it from the perspective of, I'm going to talk about Israel for just 2 seconds to give you an analogy. If you can imagine, Israel's in a pretty hostile place. Would you guys agree? But if you look at 10, 15 years ago, the people that bought real estate in Israel, I mean, it was more of a long-term play for these guys. There really wasn't as much value. You go there now, you can get an apartment that's 600 square feet for 1.2 million US dollars. So the price has gone exponentially high, partially because of inflation. And now who is the one that makes the wealth is the one who owned the real estate at the right time. And so that's the point I'm trying to make, is that tangible assets in real estate especially, they do benefit, and it becomes what we call a hedge against inflation in those inflationary markets. So that's a really good benefit that we're bringing to the table for our investors. Now, a lot of people will come to me and say, Rick, well, let me ask you a question. Like, so what is this? Kind of sounds like a REIT, what I hear in the news about a REIT. So what is the difference between a REIT and our fund? Anybody want to know that? Steve's like, yeah, I need to know that. Right. So everybody here, I want you to really pay attention, because this is really how it's tied. And there's really 2 types. So I'm going to try to explain the 2, and I might have Toshi chime in afterwards here to elaborate more. So if you look at a real estate investment trust, okay, in most cases, it is still connected or correlated with the fluctuations of the stock market. And the reason why is because there's really 2 types of REITs. And I'm going to talk about the public REITs. Public REITs are where investors like you and I, right, invest in a REIT that is ultimately investing in real estate assets. However, what people don't realize is that in a REIT, what you actually bought was a share of the company, not a share of the assets. You're just getting paid based on the revenue and the return that those assets produce for the company. So in essence, in a REIT, you never really own the real estate. You own a percentage of the company that happens to have real estate in their portfolio. So it's not a one-to-one. Does that make sense? Now, the reason why that's important to note as well is because that means that if that real estate isn't performing as much, then there is some form of volatility between the value of your stock in that company versus the real estate value itself. So really, if somebody's scared and they think your company's not producing a good return annualized, people might actually sell that stock for lower, ultimately impacting your investment wealth. Does that make sense? And so that's one of the biggest negatives. Now, the other portion of this is when you're dealing more with what is called and I'm trying to put it here because I think there's a note here and I want to make sure you guys can see it on the screen. So if you look at the liquidity, it is available, but it comes at a price, right? Which is what I just discussed. All right. Now, the next piece that I want to hit is the fact that non-traded REITs, now this becomes more of a private sector, they've almost made it like an elite type of group. There are private REITs that are not traded, but really they're connected to the wealthiest people. So for example, names like Warren Buffett would invest in private REITs. Major investment groups will come in and they'll partner up with these more boutique REITs that are not traded. And it's really what we call a club deal, right? These are opportunities. We're investing in $2 billion worth of commercial real estate assets. And in this private sector, the minimum buy-in is $5 million. So what am I saying? It's a very exclusive circle that only the wealthiest of the players can play, or the wealthiest of the funds can play. And therefore, regular ordinary investors will never be able to take advantage or participate in these kind of really sophisticated pieces. So any little guy is most likely going to end up where? In the traded stocks, right? Because there's no way they can buy into something of this magnitude. What stinks is usually those are the highest performing REITs, but it's because only the wealthy are playing in that game. So that is what makes a difference between what we're doing and what they're doing. Now, one thing I'll allude to before I show you the visual of how we operate as a fund and what makes us different is that because we are a real estate investment company and because we are dealing at a certain level of volume, there are already club deals that we're already involved in as an investment company, right? We're already working on an apartment complex out of Vegas, in fact, that we're invested in. And that's just a small piece compared to what we can do. So as investors invest in our fund, they might even be diversified in projects like these that are non-traded REITs with the elite, but they would never be able to do it on their own, except if they were working through us. Does that make sense? So that's really one of the biggest benefits that we're going to bring to the table, is we're going to bring that kind of stability, but it could be any ordinary investor that benefits from those investments that we invested. Everybody with me so far? So that's one of the biggest elements that kind of make us different than those other groups. So now, what is the fund and how is that structured? And I want you guys to visualize this. Most of you have already seen this because I like to show a lot of visual illustrations, but now I want you to understand what makes us different than those REITs. So as you can see here, ARC Fund Management is just an entity owned by his, that is the management company of and partner of Fund 3, which is a Reg A offering. All the little investors or big investors combining their money are what we call limited partners that are buying ownership in this entity. And then we have an intermediary, third-party administrators, and the auditors and everybody else that make sure that we're in compliance and that we're reporting to the Securities Exchange Commission. So at the end of the day, these are the guys that cut all the checks and they make sure that all the reports are there for all the investor shareholders. Now, what is the difference? The difference is very clear. We are part owners here. The investors are part owners here. All the assets are owned by the entity of which they're part owners of. So the difference here is their money truly is tied to the real estate owned in the fund, not necessarily the ownership of the company only. So that's what the wealthiest people do, is they create a buffer between all the real estate equity they're building versus the return they give you. Why? Because they're smart, right? They're like, yeah, I'll keep all the real estate wealth. I'll just pay you a dividend. I'll just pay you based on the company's performance. What we're doing here that makes us different is every investor becomes a part owner of all the assets owned by the fund. So they're directly tied to the real estate that we're financing or investing in. Everybody with me so far? Does that make sense? So that's really what makes it interesting. Now, the next portion is when we're dealing with operating partners, which you'll hear me say a lot, some of you guys will ultimately be entrusted to help us manage some of those joint venture partnerships, right? Which means you'll get bonuses based on that. But the reason why we can do it is because ultimately we're setting up an entity with that operating partner. We're leveraging their skills and their experience to go out there and implement one of those strategies for us. And then these assets are ultimately owned, whole or in part, by the investors in the fund. So again, they're directly connected to the entity that they're part owners of. So they're directly vested in the projects that we're in. And that's really what separates us from all those other guys. Not to mention the fact, as I talked about, diversification, right? In most of those other funds, you have the apartment strategy. That's what they're raising money like this for. In this case, we're saying, well, hey, I don't just want to have you as a second mortgage holder in a $50 million apartment complex. I want you to be vested in the loans we do. I want you to be vested in commercial projects and developments we're doing, residential rentals and flips, quick turns. I want you to be vested in partnerships that we're in projects like assisted living facilities and so forth, so that we can channel the capital based on the performance and based on the different strategies that we need. By doing that, let's say this particular segment takes a hit in development because the market shifts. We're not fully vested in one strategy, right? So we can pull that money back if we need to, reallocate it in the other investment strategies that make money, and our investors are protected. That's really the main goal. Because remember, now they don't have the same liquidity as a stock, but now they have direct connection with the tangible assets in the investments that we do. So that's really what makes us different than a REIT, and it gives us the ability to really outperform almost every other vehicle out there because they're directly connected. We're diversified in projects, we're diversified in partnerships, and they benefit. And what's cool about this, and I talked about this last week, a lot of our team members, as a part of the fund management side, you are going to be able to help us to manage these relationships. You're going to help us to sell some of these assets within the company to realize money, which gives you bonuses. You're going to help us to follow up with the loans and the portfolios and deal with maturities and things that generate revenue so that we can bonus you. So we all benefit from every department. We all benefit and we all learn and grow from leveraging this structure of the Fund 3, which is really why this is such an important vehicle for us. And now just imagine, fast forward a year from now, what do you think the market's going to look like when we start recovering from this market? Think about the pent-up foreclosures that are coming. Think about the market itself. We are positioning ourselves so that when there is a correction, we have the right vehicle with the right opportunities that everybody now gets to benefit from. And that's what I've been preaching for almost 2 years now. But now the vehicle is here and we're this close to going live. And so I think it's imperative that everyone in the team, whether you're just calling in sales, whether you're dealing with post-closing, administrative, you name it, everything that we do ultimately will impact the overall performance we have. This is why, just like the Wynn family, I want everybody to fully understand that we all play a key role. And if we work in unity, there's no stopping us. We will outperform, we'll generate revenue. And not only that, guys, but keep in mind, part of our objective is as we see you rise above the standard, when we see somebody going above and beyond and performing, part of those bonuses are not just going to be cash anymore. They're going to give you stocks in this company so that as it grows, not only do you have money bonus, but you also have the return that it's generating. And so you become an actual investor. You start building your own wealth. And this is why you have to treat it like it's your business. So whether you're there right now cleaning the door handles, it doesn't matter, because ultimately you become a beneficiary in this growth. And just imagine the future and the opportunities that we can get if we work together. But that requires that we all understand where we're going, and that at the same time, we all raise up to the next level of the standard, because that's what it's going to take for us to go to that next level. And it's time that we stop compartmentalizing things and just unite as a team to really take it to that next level. Okay. So with that said, that concludes the first part of the video. We were training our investors, and I want to make sure that if you guys have any comments or questions, we address them. If there's something you still are not clear about, this is the perfect time to address it so that we can finalize kind of our game plan. So anybody?
Hey, Rick, can you send out a copy of that presentation later? I missed the first 10 minutes because I couldn't hear your audio.
Oh, yes. No, thank you. Is it hopefully at least, so the whole 10 minutes wasn't working?
No, I don't know if other people had a problem. I had a problem, but I just
Okay.
want to make sure I get a copy of this. It was a great presentation.
Yes. Thank you. Absolutely. Got it. Mm-hmm. Awesome. Anybody else comments, questions, pieces that you don't understand?
I just think that this is very positive for everybody in the company, and even with our investors that are just having money right there that they want to put into the company. This is a great way to go ahead and say, hey, you know, you have this money, let us help you invest it, and you see the outcome is going to be worth it.
Absolutely. Absolutely. Yeah, no, you're right. This is a great opportunity for everybody to benefit. And what's really, again, part of what I love about this, tying to what you're saying is, and Toshi will attest to this, when you're dealing with some of the best investments out there, only the wealthiest people always get to play in that game. Why? Because the elite, wealth follows wealth, right? So money follows money, right? And so, but what ends up happening is then the little guys are always left behind and they never have those opportunities. And primarily because if I'm dealing with $1 billion project, do I want to waste my time with a little guy with $5,000 asking me 25 questions about the investment? Probably not, right? And so it's always like, I don't want to waste my time with these people. I want to work on the bigger stuff. And so I feel that what we're building here, this arc, becomes a bridge. And that bridge is not only to our own projects, but that we can also tap into these big level deals. And now those investors have come up through us and get to benefit in those projects. So even if tomorrow morning we decided, you know what, we don't want to do any more business, we can allocate those funds and investments like that and sit back and perform for those investors. Now, of course, it's not what we want to do, but I want to give you that perspective. And so, and then how many clients do we deal with that have liquidity issues? They want to invest in real estate. Maybe they're new, right? They're new where they want to do it. And you're like, how much money do you have to borrow for a deal? And they're like, 20 grand. What are you going to do with 20 grand? It's the same way. Most lenders are like, well, I don't want to waste my time with you. Or you're too little. I'm not going to deal with the headaches of dealing with you. Or now you could be like, hey, you know what? You may not be able to do a deal right now, but I can show how you could benefit passively and let your money work for you while you're building your wealth and getting more savings. So this becomes yet another product that we can advocate for, and it benefits you directly. So good point. Awesome. Anybody else?
I think a big breakthrough that I saw it coming, but it's almost like today it just became reality. You mentioned that as a team, the better we do, the better we perform individually. We literally could be shareholders.
Yes.
Within this. And I had the privilege, Darla and I had the privilege of working in the insurance industry, and they had that model. And you can make good money just like you can in real estate, but wealth is built in the shares. Mm-hmm. And I remember watching that we'd earn an income, but then I'd watch my wealth go up. And at the end of the game, you made money along the way and hopefully you invested that, but there's something waiting for you at the end.
Yeah.
And you're an owner. And the other thing that'll happen is all of a sudden you don't see yourself as an employee anymore. You see yourself as one of the owners. And it's just a game changer. It's very exciting.
Absolutely, it's exactly right.
Well,
And
if
that's the hope.
If
Everybody
you
sees
come
it.
into the company thinking that way, that, you know, you want to not just be an employee, but you want to be part of something, then this is the right, you know, soul and that you guys are doing this.
Absolutely. And I'm glad you guys are realizing that, because that was the goal. And over the years, we've tried to set stuff up and it just is not the same. It ultimately is counterproductive. Because, for example, even if I say, hey guys, we're going to do 20 deals together, who's going to manage those? Well, guess what? You spend your time is managing the deal, not managing the business, and the business goes out of business and you lose the deal, we all lose. In this business model, we're raising the capital. You're becoming a shareholder in a company that you're managing. So what you do every day impacts your direct investment. That's really what makes the difference here. That becomes the game changer, where before, if I give you opportunity, and I've done it, I had to have people on my team that it actually destroyed their relationship with us, because then when they didn't perform to the standard or something went wrong with the deal, that investment piece impacted your performance in the office. And then that actually hurts you. It doesn't help you. So the benefit here is we do what we do with excellence. We work, we go to the next level. And as we add shares to our portfolio, then the better we do, the better that performs. And then therefore your wealth grows and is tied to the real estate. So when we start doing big deals and you're like, hey, I'm a part owner of this massive project over here. Hey, I'm a part owner in the $120 million in loans we're doing. That's the beauty of being able to benefit from that. So what you do directly impacts the fund's value and the growth. So there is no conflict of interest, or there's no derailment of the benefits. So that's what I'm super excited about. So awesome. Anyone else? Comments, questions? You guys got some good points, and it looked like everybody's quiet, and everybody starts looking at Stephanie. Stephanie, dissertation.
I'm always quiet. I'm good.
No, I'm excited. I'm just trying to find properties so we can spend the money.
That's it. You got it, girl. Yeah, we want 10 more at least. Let's do it.
Bingo.
Awesome. So cool. If that's the case, if you guys don't have any more comments or questions, and we're going to wrap it up for the week. And again, I just want us to take that mentality that was just brought up. You know, number one, get a better understanding. If you don't get it, what we just talked about, you know, ask questions. There's no dumb question. I would rather everybody understand and be moving forward in the same direction than I would want us to be confused and have division in our company. And so again, I just want to remind us to really stay focused as a team and remember these pieces that we talked about, because all participants must understand the end result. That's really what it comes down to. And we have to be empowered. And hopefully you guys are seeing, I'm doing my very best to empower you, to release you so that you understand, hey, so for the rest of the week, start thinking about that. Hey, I'm going to be a shareholder. This is my company. What can I do to add value so that I protect and make the company perform? And I think if we all take that mentality, there's no more excuses. There's no more complaining. There's no more grumbling. There's no more pointing fingers. There's only, hey, how do we get better? Because we all get to benefit from this in the long term. So with that said, guys, thank you so much.
If I can just say this, you know, sometimes when we look through the eyes of another lens, or, you know, somebody else, that tends to give us a different perspective. After dealing with a webinar last week with NAREP, seeing the reaction of our future operators, including one that, you know, was ready to give us a commitment the day we met with them, of how big this is. Seeing it through their eyes really gives me an entirely different perspective of the impact and the ripple this can create. And I'm just hoping that some of that bleeds off into our own staff, because we are kind of quiet. We go about it. We're always engaged in what we're doing every day. So we don't see the rest of the forest. We're only looking at the trees in our little circle. So guys, I implore you to kind of take a step back to really see how big this is and how great a role we can play in impacting the lives of others. And not just through our philanthropic scenarios, but just somebody investing ourselves, particularly, right? That what we could do for our own futures is the seeds that have been planted here. Rick, Luis, I thank you so much for allowing us to be part of this vision, and to helping us get this to the finish line properly. So thank you, man. And everybody, I got to tell you, put your seatbelts on. This is going to be one heck of a ride.
Absolutely. Absolutely.
Agreed.
Awesome, guys. Well, thank you guys so much for your time. Let's rock and roll. You guys have an amazing week.
All right. Thanks, guys.